All right. Good afternoon, everyone, and welcome to our webinar on what is an option, part two, with National Bank Direct Brokerage. Today, we'll be looking at evaluating options. I'm Bobby Argitis, Senior Investment Specialist here at National Bank Direct Brokerage, and I have with me Mr. Pierre Laroche, Managing Director of Business Strategy at NBC Financial Markets, who will be our expert in options. Now, this is our part two. For those of you who were there for our first webinar, we talked about what are options, what's a call option, what's a put option. One of the things that was brought up was this famous premium that you're either paying to buy the option or receiving if you're writing options. So there, obviously there was questions about how is this premium determined? What's a fair premium? What's a high premium or low premium? So there's obviously behind the scenes things that are done to determine what the premium is. And for that, Pierre, in just a few seconds, we'll take control of the presentation and talk about that. Obviously, the content in the webinar today is just for information purposes. It's not a recommendation on our part. We're just looking here to give you to help you out, and obviously, please take your time to do your own research. The webinar is going to last between 45 minutes to an hour with questions. And without further ado, I'll pass it on to Pierre to continue. Pierre, go ahead. It's all yours.
Thank you, Bobby. Thanks for the introduction. Hello, everybody. Being back for part two. I hope that this second webinar will be as interesting as the first one was. Since you're there, we have high expectations, and we'll hope that we will meet them. So as Bobby said, right, this is a purely educational webinar. It's not a recommendation. So we will take a few examples, give a few examples. It's not a recommendation, a trade recommendation. It's not a solicitation for a trade neither. It's purely, to help you better understand what options are, and in particular today, how we value them. So it's the second of our three seminars, and it follows what we saw last time. The last time is that we went through very basic definitions of calls and puts. We tried to explain what was their profit function. So when you buy an option, you sell an option, or you write an option, what will be the payoff at maturity or before maturity. And we saw simple uses of options. And other simple utilization uses of options, like buying a call and we compare that with buying the underlying asset. What are the pros and cons? What's the different risk-return profile? Or comparing buying a put with short selling, the underlying asset. So what are the pros and cons, differences and similarities? And so now we are ready, as Bobby said, to get into more details about what does determine the options premia. So premia is like the price of options. It's two terms to designate the same thing, the price of an option. And so we will go through, very basic pricing models so that you understand that, options premia don't fall from the sky. They're well determined, by arbitrage conditions, with well-defined formulas, which are a bit complicated, but the idea here today, it's not to go into deep details, it's just to make you, understand, the general principles, that underlie, options pricing. And so we'll go through that. After, we will be able to review what are the factors that do impact, options prices. And so if, volatility goes up, okay, what happened to options prices? If, interest rates move, what's the impact? Is it big or is it small? In what direction? That kind of thing. And then we will finish with the notion, reviewing the notion, a very important notion of implied volatility, because as you will see, volatility plays an important role, in determining, the premia, options premia, the price of options. So to be successful in options trading, you need to have a good view on the price of the underlying asset, but you also have to be have a good view on where the volatility is heading. Is the volatility going to go up or down? Because as we will see, it does impact a lot options prices. And so this is one of the additional challenges that trading options bring with respect to trading other more fundamental asset classes like stocks or even currencies. Okay, so if we're okay, here we go. Let me just take a little sip, and here we go. So options are financial assets, as any other financial asset. Their pricing obey to the single one fundamental principle that the price, the value of a financial asset today is the present value of the expected future payoffs. Okay, so in the case in the case of bonds, the value of a bond today is the present value of the coupon, which are paid usually every 6 months, and the face value at maturity. So the present value of the coupons and the face value, we sum all these face value, and we obtain the value of the bond. For stocks, the expected payoffs are dividends, right? And so we try to forecast, future dividends, and we discount them. And the discount rate, at which we discount the cash flows is, the risk-free rate plus a risk premium. As we will see, so options, they do obey to the same principle. We will have to estimate what will be the payoff at maturity of the option, and then we will discount them, and so to obtain, today's price. The only difference in option pricing and pricing bonds or other fundamental assets like stocks is that rather than including the risk premia in the discount rate, we will include the risk premia in the calculation of the expected payoffs. Okay, so we won't show like the mathematical formulas by which we do this, but just believe us that this is done. So you will see in the formulas that we discount the cash flows at the risk-free rate for options, but the expected cash flow, the expectation does include, they are risk adjusted. So the risk premia is indeed taken into account, but not in the discount rate, but in the expectation when we calculate the expected payoffs. So aside of that little difference, there's no fundamental difference between pricing and options or pricing a more fundamental asset like a bond or a stock. Okay, so here we go. So this is what I just said, and so just to illustrate the principle, we'll use a very simple model, option pricing model, which is called the binomial option pricing model, which is simple but very interesting, and that we indeed use, in real life here in financial markets and on any bank, when we need to price some options. And we'll take the example, of this call. Okay, so the call on an asset, a stock, a bond, whatever asset, okay? So the underlying asset is currently priced at $100. The strike price of the call option is 102. So currently, the option is out of the money. If you remember this notion of being out of the money, in the money from the previous webinar, so right now, the call option is out of the money because the buyer of the option would not exercise the option if he or she wanted to buy the stock, the underlying asset, and he or she would be better buying enough at $100 on the market rather than exercising the call option and have to pay $102. So currently, the call is out of the money because the current underlying asset price is below the strike price. Then we'll assume that the volatility, because of that underlying asset, is 25%. So this is like the standard deviation, annualized, standard deviation of returns of the underlying stock, which is like roughly what most Canadian stocks, their annualized volatility hang around this number. It can be 20, it can be 30, depends on the risk, of the shares. We'll assume that the risk-free rate annualized is 4%, and that the option will mature in 1 month from now. And to begin with, we'll start with a very simple binomial option pricing model that has a one-time step. So it is today and a month from now, okay? In real life, time passes by continuously, and we will get back to that. But right now, just take for granted that there is one-time step. We buy the option today, then there's a break in the continuous time, and then we arrive at the end of the 30-day maturity period. So here we have calls. So currently, the underlying asset is worth $100, and from the volatility data and from the risk-free data, and if we had more time, this is where we could calculate, show in more details how we get to these numbers. We can show that, given the data that we provided in the little table at the lower right of the preceding page, that given this information, the binomial model suggests that the stock could either go from $100 to $107.48, or go down from $100 to $93.04, and the risk-adjusted probabilities of going up is 50.5%, and the risk-adjusted probability of going down is the complement, at 49.50. So this is the expected, expectations underlying, the binomial model, given the information we had on the risk-free rate, the volatility, and the maturity of the option, so in a month from now. And now let's build, the binomial tree of the option price. So we know that option has a strike price of 102. Okay, so what are the terminal payoffs? So when we price options, we always begin with figuring out what will be the terminal payoffs, and then we work our way back, okay, until we get today. So if the first scenario, the stock goes up to 107.48, the call, matures in the money, so the buyer will exercise the option to buy the underlying asset at 102, while the asset is worth 107.48, so the payoff is 5.48. If, in the other case, the stock goes down with risk-adjusted probability of 49.5, so it goes down from 100 to 93.04, the call option matures out of the money because it's cheaper to buy the stock on the market rather than exercising the option. So, the terminal payoff will be 0. Okay, so in the first case, the stock goes up, the option ends up in the money. And if the stock goes down, the underlying asset stock price, goes down, then it matures, expires out of the money so that the payoff is 0. Then we simply use the same risk-adjusted probability to calculate. So we pedal back our way, right, to estimate today's price. So what is today's price? Well, it's 50.5% chance of a $5.48 payoff, right? And a 49.5 chance of having a $0 payoff. So we just sum these two expected value and we discount them at the risk-free rate. So if you go back to the little table at the lower right of the preceding page, the risk-free rate was 4%, which is 0.33% per month. So you just discount this risk-adjusted payoffs and obtain 277. Okay. So the 277 is the present value of the expected payoff adjusted for risk. As we would have the same principle as for stocks and bonds, it's just that the risk premium is not applied at the same place. So in this example, we have a giant time step of 1 month. So the resulting call price estimation of 277 is not really reliable. So if we did, a binomial tree with many little steps, like let's say hourly steps, we would get to a much more precise evaluation. So suppose that we have like a continuous, right, time step, now very, very little time steps. We would see that, the estimated value of the call converges to $2.13, and the value, the corresponding value of the put, so the same maturity and the same strike price would be $3.79. Okay, so let's we will deal with these two more precise values going forward. Just to tell you that why using the binomial model is very interesting is that you can calibrate the time step so that a time step falls at an ex-dividend date for stocks. So that when a stock pays a dividend, the stock price value decreases by the present value of the next dividend at the ex-dividend date. So what is very interesting with the binomial model is that you can fit the time step to match, the ex-dividend dates so that you can fully capture the impacts on the call price or the put price, of dividend payments. And so also it is interesting to know that in the binomial model, at each step, you can verify, is it better to keep the option for the next step or exercise it right now? Because, as we said in the first webinar, most stock options, options on stocks are of the American type. This means that it can be exercised anytime before maturity, whereas European options can only be exercised at maturity. So the binomial model is super well adapted, to this type of stock options. And most options around the world are American options, not European options. So I just want to tell you that this is why we do use it in practice, when we need to price simple or more complicated options, often, as much as possible, if we can rely on the binomial pricing model, of course, more sophisticated than the what step that we presented, but you get the picture, and we do indeed use it in practice. So the binomial model converges to when we have very, very, very small, not daily time step. I mean like millisecond time steps, so what we call continuous time. The binomial model converges to what is called the Black-Scholes model, the Black and Scholes model. So Fisher, Black, and Myron Scholes. It was published in 1973. It was a breakthrough. They came up with the first proof of how to value option with no arbitrage, meaning that, we were sure that from these formula, we would have like the true, fundamental value of options around which we can trade, right? And so Fisher Black was deceased, but Myron Scholes won the Nobel Prize in economics, a few years after this discovery and publication, because it really changed the world. From the mid-70s, now we knew how to price options, which was not the case before. And so this is why the options market took so much popularity and became a big thing in financial markets since then. And so the Black-Scholes model goes as follows. It may be very, very impressive for those who are not familiar with mathematics, but it's nothing more than the expression of the expected value of the terminal payoff of, in this case, the call option. You know that the call option will be the difference between the stock price at maturity and the strike price for different possible stock prices. And so what this option says, this formula says is exactly that. So the expected payoff would be S at maturity minus K. So this is the current stock price, but we adjust it for its possible, future values, and we subtract, the strike price. So as we did with the binomial model, except that having many nodes that we have to backward calculate to get to today's price, we compress all these different paths, into one relatively simple formula. and the adjustment for risk, is made within D1 and D2. So D1 and D2 are linked to the probability of the option of maturing in the money. And this is where, hidden in D1, we don't give the details. D1 is another formula, but just to tell you that volatility is one of the important factors, in the values D1 and D2 that determine the probability of the underlying asset, maturing, in the money. Okay, so using this formula, it's easier to see, what are the factors that impact option prices, and we'll get back to that in the next slide. Meanwhile, you don't have to calculate, to program the Black-Scholes formula or the binomial model by yourself. All the options exchanges, they do offer an option pricer, and NBDB, do offer you, the possibility to price option within the OptionsPlay tool, which is, available to NBDB customers. And there are some videos, on how to use OptionsPlay to, to refine or to help you, come up with better options trading strategies. And so you will be able, to value options, for different volatility scenario, for different maturities, etc. So it's very well done. So please refer to the OptionsPlay webinars that shows you how to use OptionsPlay, if you want to know more. So you don't have, to bother programming. Some of you, I know, have the know-how to do it, but frankly speaking, use these tools and then use your time, to better figure out, different potentially good options trade. So then, okay, so we can see, and it is important that the option premium, the price of the option has two components. One component is called the intrinsic value, and the other one is called the time value. The intrinsic value is what would be the profit if we exercise it now. So if we go back, to our example, the call, has a strike price of 102, and the underlying asset is $100. So currently, the call option is out of the money. Sorry for the coughing, and its intrinsic value is 0. Then, on top of even if the intrinsic value is 0, the option is still worth something. It's worth the time value because, there is still a month to go before maturity. And within a month, the stock can easily move, above 102, right? And so, and we know that the call is worth 213 and the put is worth 379 using the Black-Scholes or the very refined, with the binomial model with very small time steps. So that we know that in the case of the call option, the initial, intrinsic value is 0 because here, $100, the current stock price, the initial stock price is below the strike price. So intrinsic value is 0, but the time value is the difference between the calculated option premia, 213, minus the intrinsic value. So in the case of the call, 100% of the option premium comes from the time value because the intrinsic value currently is 0. Then for the put option, it's different. We know that the put option, so you have the option to sell at 102, something that is worth 100. So in this case, you have a positive intrinsic value because K is higher than S, the value of the underlying asset. K, once again, remember, it's the strike price. So in this case, you have a positive intrinsic value because you are able to sell, in the case of the put option, at 102, something that is worth 100. So for, the put option, the intrinsic value is $2. Remember, it's the same strike price and maturity for these two options. Then what is the time value? Well, the time value is the difference between the calculated value of 379 minus the portion of it that is the intrinsic value. So 379 minus 2 is 179. And being 179, then, this is like the time value. So it is important to distinguish between the intrinsic value and the time value, because when you buy an option, time, still goes on, right? Time passes by. And the fact that time passes by, it will impact, the value of your option, because the closer we get to the maturity date, the lesser time value has. And so the time value shrinks. Okay, and we'll get back to that in a few slides. So this was one of the key notions that we wanted to address in this particular slide, the fact that intrinsic value varies with respect to variation of the underlying asset price, but the time value is a function, of the time to maturity. And as time passes by, the time value shrinks and converges to zero, as we will see later on.
Chair, one of the questions I have is on the time value. So perfectly understood that volatility and time to maturity will have an effect on the option price. But what are the other factors? Well, I guess I see it now on the screen, but what are the other factors that could have an impact on the option price?
Well, it's a very good question, Bobby, and you're exactly right on. Congratulations for the auditor, that does this. So on page 14, we list, right, the 5 factors that do impact call and put prices, call and put premia. So first of all, as we said, what we call the moneyness, so which is the gap between S, the underlying asset price, and K, the strike price. So this is the moneyness. This is linked to the intrinsic value, as we saw. So an increase of S, so a greater gap between S and K, is good for calls, but it's not good for puts, because, of course, the put we want to sell as much as possible. Then it increases the interest rate. If you look back at the Black and Scholes formula, and you look back at the binomial formula, you see that the interest rate is there. We discount the cash flow and the risk-free rate. So you see that the risk-free rate also impacts. So if the risk-free rate increases, it does push up, the call price, but it impacts the put price, downward. So, but it's not, as we will see the numerical example next page, it's not a very big factor. Even if rates go up by a lot, the impact on options prices is not that important. As we said, volatility is super important, in options pricing, and a rise in volatility will impact positively both the call price and the put price, both of them. And and the reason why it is because the higher volatility, the higher the probability of the option, maturing in the money. And so it pushes up the expected terminal payoffs of the option. So it pushes up today's option prices. Then, of course, time before maturity. So, of course, if you have one option, it has one, maturity date. But you may consider 2 options. One, with the same strike price that matures in 1 month, and the other one matures in 2 months or 3 months. Then, of course, the more time you have before maturity, the better it is for both option prices, because, in both cases, it will increase the expected, terminal payoffs. Because if you have more time to go before maturity, there's more chances than the option, matures in the money. And then regarding dividends, as we discussed, that for stock options at the dividend date, the option price, the stock underlying asset, the underlying stock price goes down by the present value of the dividend, right? And so, of course, if the stock price goes down, of course, it impacts, downward, the call premium, and it does impact, reciprocally upward, the put premium. So, and now, how sensitive are these factors, Bobby? So, following this great question from our guest today, is that the call option, is currently up to 13 with our example, and at 379, and the current that underlying our example is that currently the underlying stock price is $100. The current risk-free rate is 4%. The current volatility of the underlying asset is 25%, and the option has 1 month maturity. Okay, suppose that, suddenly following a good news, let's say an earning announcements, earnings beat expectations, and bang, the stock right on the sudden, within a second, jumps to 110. So how would that impact? Well, it would have a tremendous impact on both call and put prices. First of all, for call prices, it would go from 213 to 886, a 316% increase, in the options price. So in this case, someone who bought it at 213 and is facing this very happy situation, then, could simply sell back the option at around 885, something like this, 886, right? There is the bid-ask spread around this number, but it would be a tremendous gain. But regarding the put, if you were buyer of a put, you bought the put for 379, then following this announcement, the put would go down to 52 cents, a negative return of more than 86, minus 86%. So, big mess. So it's a 10% increase, creates a 300% increase of the call price and a minus 86% decrease, in the put price. So, and this is like the implicit leverage that we explained in the first webinar, the leverage implicit to option prices that we explained a bit in the first webinar and that we show again here in this second webinar. Then suppose that we go back to $100. Okay, so the underlying stock price is still at $100, but the risk-free rate suddenly increases to 45. If McLean, or any monetary authority decides, oh my God, inflation is still around, we don't maintain the rates at the same rate, or we don't lower them, we raise them from 45. This is a bit exaggerated. It's a big move. No central banks would do this, but assume they do. It's a big jump, right? Well, this big jump, would not have that much an impact, of the option prices. The call price would go from 213 to 216, and the put price would decrease from 379 to 374. So a 25% increase of the risk-free rate, which is like gigantic, merely does not impact. It's not really material, right? And so as I said before, and you see this numerical example shows that, you don't have to be bothered too much, with the rate announcements when you trade options. Okay, we go back. Okay, stock is worth $100. Risk-free rate is at 4%, but now it's the volatility that rises from 25 to 30%. Following, I don't know, whatever change in the company's business environment or capital structure. So in this case, volatility goes up. So we know that when volatility goes up, then the expected, the probability of ending up in the money and deep in the money is higher. So it raises both the call and the price option. By how much? Well, the call in this case would go from 213 to 269, an increase of 26%, and the put would go from 379 to 435, an increase of nearly 15%. So this numerical example shows you that more volatility does positively impact, call and put prices, but to a lesser extent, than especially, the moneyness. And then suppose that rather you're considering two options. So both of them, the underlying asset price is 100, risk-free rate is 4%, volatility is 25%, the base case. But you're considering two options, with the same strike price, 102. Okay, and one goes would mature in 1 month, the other one in 3 months. So what would be the price difference? Well, the 1 month is worth 213. The 3 month is worth like twice as much, like 449. And the 1 month put is worth 379. and the 3-month put is worth 6.15, so a major increase. So you can see that the further away, is the maturity, the higher the time value is, and it's quite a material factor as well. So when you have to decide, will I buy short-term 1-month options or longer term, keep in mind that longer term are interesting. You have more time, things can happen, but you would pay for it. You'll pay quite a lot, right? Going from 1 month to 3 months more than doubles, the call price and increases it by more than 60%, for the put price.
Pierre, I have a question. In terms of the disparity between let's say going from 1 month to 3 months for the call, it's up quite a bit more. Is it because the call option has the potential for unlimited upside, while the put option is that the reason, or there's other stuff?
Very interesting. So in the case of a call and put, the downside doesn't really matter in the sense that, it's zero. If the call matures out of the money, no matter how deep out of the money, it's the same payoff, it's zero. So the fact that if we compare a 1-month call with a 3-month call, indeed, because buying a call, Bobby, you're perfectly right. There is no theoretical, limit on the upside. If the underlying stock quadruple, like the NVIDIA, something like this, there's no limit to the upside of the call option. So this is why, you have a higher impact. For the put option, so suppose that on contrary, finally, all the new NVIDIA chips, I don't think it's the case, right? It's just like a phony example. It's not a recommendation. And so just suppose that finally, everything goes wrong, with NVIDIA or any other company, and it goes bankrupt. So there's a cap, if you remember, the put option profit graph, when you buy a put, you cannot do more money than the difference between the strike price and zero. So there is a limitation on the maximum. There is a maximum profit you can do on a put. And so even if you take a 5-year option, right, a 5-year option, of course, the call price will go up much more than the put price, because you cannot, the stock price, the underlying stock price cannot go below zero. Okay, so this is exactly why here, the additional upside, is a bit less for the put option than the call option. Very clever. So, okay. So then let's go back, let's go back to the time value. Okay, as we said, the premium, when you pay for an option, the premium you pay has 2 components. The first one is the intrinsic value. Is it in or out of the money as we speak? The second one is the time value. As we saw in our example, for the call option, 100% of the premium is time value. As for the put option, which is worth 3 something, there's $2 intrinsic value and 1 something, dollar of time value. So time passes by, right? Time passes by, it's inevitable. And so, the time value will gradually decrease as time passes by and we get closer to the maturity date. Okay, so we did illustrate this, by a little example. Suppose that you have an option that does mature in 4 months. 4 months. Okay, so for the first 30 days, during the first month, the time value would go from this value to this other value. It's very small. It's a small decrease for the first month. So we are now 3 months away from maturity, but the time value did not decrease a lot. And of course, everything else is supposed to be held constant, that the stock price doesn't move, interest rate and volatility, just the impact of time. And then going from 3 months to 2 months, well, the time value also decreases, but not that much, but still a bit more than for the first month. Going from 4 to 3 is smaller than 3 to 2. Smaller than 2 to 1, and look at the loss of time value. Look at the loss of time value, for the last month. Half of the time value, more than half of the time value is lost during the last month. So this is a very important, we call that the time decay, So the time decay function that we show here is very important when you have to choose, okay, an option. So suppose that if you buy an option because you accept let's say you buy a call option because you would expect, the underlying asset price to go up. And the call is very short term, let's say within a month, that this, jump in the underlying asset price has to happen like very rapidly because the time value of your option decreases. So even if the underlying stock goes up, you still may lose on the option because, of the time decay. So it really needs, when you buy a short-term call, you need a big jump, in the underlying asset price to make sure that the positive impact of a higher S is higher than the impact of the time decay. Of course, then we say wow, okay, so when we sell options, we sell call and we sell put. In this case, time is on our side because, when we sell options, we sell call and sell put. It's very risky. These are, as we saw last time, these are risky positions because when you sell option, you receive the premium, but you're obliged, to follow up if the buyer of that option decides to lift the option, to exercise the option. So when you sell options, or write options, the time is on your side because as time passes by, we get closer to the maturity date, and the time value goes down. So if nothing else moves, you will have sold the option at a higher price, which has a tendency, the time value of that initial premium will have the tendency to go down and very rapidly towards zero. So, okay, take that in mind, when you want to buy or sell options, near term or longer term. Okay, because this feature, the way that the time decay, is, dysfunction, right? It's very particular. And look, keep in mind that the time value erodes very rapidly towards the end as we approach the maturity. So then we saw that, of course, the underlying asset price is a super important factor for options. We saw that volatility is an important factor for options as well, time to maturity as well. So every option has its own volatility. Every underlying asset has its own volatility. So every option, has its own underlying volatility. But the one thing that professional option traders do, okay, is that they also look at like the overall volatility of the market, and which is called like the implied volatility indices. So it means that what is the implied volatility of an option on a stock index? The most popular one is the VIX. Okay, it's the VIX index. We will allude to it in the next page. And the implied volatility is calculated as follows. You take any option pricing formula, like the Black-Scholes. You observe what is the current call price or put price, okay? And you see what is, so we know when we value an option, we know what the underlying stock price is, we know what the strike price is, we know what the interest rate is, and we know what is the number of days left to maturity. We know everything except the volatility factor, sigma. So the implied volatility is what volatility is such that the value of the formula equals, the observed price, the observed option price. So the implied volatility gives you an idea of what is the general level of volatility on the market right now. So when there's a high risk aversion, where there are a lot of uncertainty, geopolitical, the implied volatility of stock indices tend to go up, okay? And when things are calm, they tend to go down. And so you have to take that into account when you trade. You trade, for instance, the VIX, which is the implied volatility of the S&P. The S&P is the most traded, like the stocks in the S&P, most traded around the world. They are very liquid. These are big companies that do business around the world. And so it is generally the VIX, implied volatility of the S&P. The options of the S&P 500 is probably the most well-known and follow, watch upon. People focus a lot on this one. And you can see that, as it is the case for most implied volatility, it has a tendency to oscillate around certain mean. In the case of the VIX, these are options on the Standard and Poor's. So the long-term average is more like 18-20%, something like this, right? As we see here. And so currently, this screenshot has been taken a few weeks ago. Currently, maybe about 13-14%, so still a bit below the long-term potential. But we can see that when there's a big event, like here, the start of the COVID global pandemics, right? You can see, oh my God, it was like the end of the world. People were super risk off, right? And so the implied volatility jumped a lot, up to above 80%. And then as time passed by, people realize that, okay, it's not the end of the world. Humanity should survive, the pandemics. And I'm half joking here. We really had serious questions, about what would be the state of the economy, as the pandemics evolves. And then when we market participants saw that finally, there would be horrible damages, many people dying, there will be over mortality, but not the end of the world. And so then, the volatility reverted back, to its long-term mean. And for lesser shocks, there are lesser good news, bad news, some spike in the infection rates, or here news by the Fed, So the smaller spikes, they tend to revert quite rapidly. But the big spikes, they take more time, to revert back to the mean. So what I want to figure out, what you are about to decide, you have a bullish view on the underlying asset, let's say whatever stock, right? So you have two options, right? Not a plea of word, nearly, right? You can buy a call, or you can sell a put if you want to benefit, right? We saw that last time, right? And so then if you buy a call and the implied volatility, so the general volatility of market is very high, that probably calls are expensive, because the higher the volatility is, the more expensive, the premia is. So, but if on contrary, like it is a bit today, or it used to be sometimes, quite below the average, when you buy a call or any option, same thing if you buy a put, that the general level of volatility is relatively low or lowish, then you don't pay the options, a very they're not expensive, that much expensive. So, and that, volatilities, they have the tendency to go back to their mean. When they're below, they will go up. When they are above, they will go down to their mean. So they oscillate somewhat, around that 18-20% average for the VIX. So what I want to tell you here, and what you need to understand is that to be successful in options trading, not only do you need to have a good view on the underlying asset price, but you need also to look at, okay, what's the level of volatility? And then and you can look at the VIX or any other equivalent implied. There is a Canadian equivalent of the VIX, right? And you can see, okay, so in general, is volatility high or low? And this must be taken into account when you choose between, let's say, buying a call or selling a put, if you have a bullish view on the underlying asset. Okay, so implied volatility, you definitely should pay attention to it, in your decisions, on what kind of options you buy or sell, or options you buy or write. So this is exactly what written, words of what I said, and this adds, the fact that you not only have to have a good view on the underlying asset, but also on the VIX, adds to the challenges of successfully trading options. Sorry. So options trading, it is very challenging. It's very interesting. It has relatively high expected return, possibilities, but the risks are high because, there are many factors to take into account, and it's not easy, right, to jungle, with all these disinformation. So expected return is high, but the risk is high. And but it is so much interesting, and any experienced option trader usually will also look at the implied volatility to increase the return on his or her invested capital in options. So at this point, Barbel, I don't know if you had a few questions that piled up, or you want to open the session for open Q&A session.
Hold on a second. Sorry, I was in all honesty, Pierre, you were essentially answering them as you went through the presentation. So I guess the only question where I'll be honest, maybe I didn't catch on, but there is a question on the moneyness. Maybe if you could explain a little bit more this concept of moneyness, but I think that's the only one that hasn't been answered.
Very good question. It's a technical term, moneyness. Moneyness refers to how deep in the money or out of the money an option is. So let's go back, to a slide. So moneyness relates to intrinsic value, right? In the sense that suppose that you have underlying asset that has a strike price, as a current price of the underlying asset of, let's say, $100, and the strike price is $10 for a call option. Now, if the strike price is $10, so you can buy at $10 something that is worth $100, you can see that this is a deep in the money call option, because the strike price is so much lower than the current underlying asset price. So the moneyness is deep. You're deep in the money. But suppose it's the other way around. That for the call, the strike price is $100 and the stock plunged to $10. Well, this is a deep out of the money option. So the moneyness here is deep, but out of the money in that second example. So moneyness simply refers to how big is the spread between the underlying stock price or the underlying asset price and the strike price. So the bigger the gap between the two, the more the money, the higher the moneyness is, either positive in the moneyness or out of the money, negative moneyness.
Okay, perfect. All right. There's not really any other questions that really haven't been unanswered, so maybe we can just give them a little bit of a scoop of what's happening in our third webinar, and then we can wrap it up.
Yes. Okay. Thanks for the opportunity. So first of all, thanks everyone for your time, for your attention. We hope that you will enjoy this second webinar, which dug into more details in the what factors do impact, option premia, as Bobby said, right from the beginning. So now that with the first webinar, the definition, basic concepts. With this second webinar that we are ending today, we are good, to go with the notions of what does impact, option prices. So with these two very strong foundations, now you would be ready to address, more advanced option strategies that we did not address so far. There is an infinity of option strategies, and we spend the next hour together, exploring some of the most popular ones. So it will be on May 28th, and so we hope you'll be around, and that we'll have the great opportunity, to give you some more notions on options as a whole.
Excellent. And maybe just as a little bit of a teaser, I know we used the word sophisticated option strategies, but there are also some for I guess more general ones. So don't I honestly think it's It's certainly a webinar. If you stuck through the first two, I think the third one is really going to be good. Good to tie everything together. And again, we're going to have a little bit, strategies for every type of investor here. So I'd highly recommend joining us for the third one. And on that note, listen, I'd like to thank everyone for spending their lunch hour with us to learn about options and that that pricing premium. Pierre, again, thank you for this excellent presentation. The material, the time you put into this, always very much appreciated. And on that note, I'd like to wish everyone a great day. Thank you for coming, everyone.
Take care, everyone. Thank you, Bob.
Bye.